welcome you to today's BI Energy Exchange. This is the last one of the year, and at least some of us are festively dressed for the occasion. On the call today over in London, we've got Patricio Alvarez joining us. In Lisbon, we've got Joao Martins, who's joining us for the first time, who works with Pat very closely, swinging around to the US here at 731 Lexington. We've got Fernando Valle at his usual desk. We've got Alessio Mastrandrea, also normally based in London, but joining us here today. So this is the crew for the last one of these for the year. And so I think we normally like to kick things off with a sort of just commodity check-in. And I'm looking at the screen. Brent's at about $80 a barrel and change. And so, Fernando, what's your latest pulse on the market? We were talking a little bit before things got rolling, but if geopolitics or any of that having a whole lot of influence on the oil market at the moment, in your view?
Yeah, absolutely. I think there's really a confluence of three factors that are helping. One is just it tends to be a more thinly traded market, so any news tends to have larger consequences in December. That's just the seasonality of it. And then the bigger impacts, as you mentioned, the Red Sea attacks, potentially disrupting a corridor that takes around 8 to 9% of crude supply globally, so a significant portion. And then I think the Fed's more dovish stance on last week's meeting is also propping up markets a little bit. If they, there's a little bit of disagreement on whether that meant cuts or just, again, how many cuts next year. But if there are cuts, then that would theoretically be supportive to demand. And you would also indicate that the economy is in a better spot than anticipated at this stage. Again, I think it's too early to declare victory on a soft landing. We see signs on the credit portion of the equation that look a little bit more dire, but it's certainly been more positive news, at least at the face of it, for oil, both on the supply and demand side.
Patricio, I want to bring you into the conversation as well. I know that gas has really eased over the course of the last 12 months, but maybe a similar question, because I think there might be a tie-in on some of the challenges in the Red Sea and how you think about the European gas market. So what about geopolitics and European gas at the moment?
So far, I think a good way to describe it would be that the weakness that we're seeing in demand has muted most of the supply risks that is still lingering out there. So thinking about the Red Sea attacks, that is a corridor that is being disrupted. We've already started seeing LNG cargoes divert and go through circle around the Cape of Good Hope. So what that will do is definitely increase shipping cost, cause major delays, and potentially also pose some upside risk for gas prices. But that said, yeah, on the day of the attacks, when these were announced, gas prices rose about 7% on the afternoon when this was announced, and in the morning they fell again by 7%. And right now, they're actually they're tracking close to a 2-year low for these time of the year. So we're tracking at around 33 euros per megawatt hour, and the long term, let's say, average is close to 20 to 25 euros. So we're actually closing to normality again in gas prices, but that's mainly a demand story. But if these disruptions do extend significantly, that could cause some pressure potentially in the first quarter, I would say. But that said, only about 5% of our supply in Europe comes through the Suez Canal and that route. So it's not a major impact at the moment.
Fernando, I want to come back over to you and just kind of think big picture about oil macro in 2024, thematically, what are the companies in your space really focused on for the year, and what kind of commodity price level is needed for them to achieve all of their financial goals?
Well, I think consolidation is probably the big theme in between Exxon acquiring Pioneer and then Chevron acquiring Hess, then now Occidental with Crown Quest, and I'm sure we'll see more movement over the next few months in oil and gas. I think if you ask them, they'll tell you that it doesn't matter what the oil price is, and I kind of tend to agree with that because you're a price taker on both sides. So you can't really control that so much, and so cost reduction is really at the forefront of their minds, and then I think the acquisitions are around employing capital where it's most cost efficient to you. So when you look at what Pioneer and Exxon would have done separately, combined, they're probably going to do less. Because they'll focus on the areas that are most attractive to them and where there's a higher marginal return than as separate entities. Same with Exxon and with Chevron and Hess. I think when you turn to refining, there's really a focus on how to manage the renewable fuels obligations and how to manage crude supply. There's been such a shift over the past 5 years. First going full light because of all the WTI growth. And now, as we've done that shift, and there is no more ability to move some of the crudes from West Texas to other parts of the U.S., it's really about having flexibility of supply with Venezuela crude coming back, with Canadian crude getting back to its peaks. So it's really focusing on that flexibility of supply and that flexibility for the refining side of the equation, and working again. I think they'll have to put a big emphasis on reducing costs because we just had the best 3 years in refining's history in the U.S. And when you come off of that high, you're going to have to temper the cost. It's just a reality of the industry. Every single price that have come up, including your labor costs, and you're going to have to temper that down as margins come back down to earth.
I want to ask you a little bit of a follow-up. I saw an interesting quote from my former colleague Jim Burkhart over at S&P these days, and he was talking about 2024, and one of the things he noted that the U.S. is producing more oil than any country in history, and he noted that the amount of oil, refined products, natural gas, liquids, and everything is near the total that's being exported from the U.S. is near the total production of Saudi Arabia or Russia. Do you think that there is going to be a big continued focus on kind of the U.S. production landscape, and kind of where does that fit within the overall sort of oil market for 2024?
Well, I would say, if you'd have to also include all the refined products that are exported from Saudi Arabia and Russia because they don't just export crude either. So I think partially the reason for that are the difficulties in building new pipelines, the difficulties in shipping, and as I mentioned, that we are maxed out on our light crude oil capacity unless you take it to the East Coast, which we can't really do. So I guess long story short to say, I think we're seeing the WTI discount to Brent widen again, partially because supply for Brent has been cut, and while WTI is still rising, and partially because the world is a little bit more saturated with light oil than with heavy and medium sours, and I think that hasn't changed. The big question for next year is really less about my companies and more about the private and smaller independents, because as that discount widens, if oil prices are still low and interest rates are still high, they aren't really making money. It doesn't matter that WTI is at 73. If all your inputs have gone up, and then your cost of finance has quintupled over the last year, and they won't grow. And as I mentioned, my companies are going to grow less fast than they would have had if there were two independent companies that now combined. So overall, I think the pace of growth will decrease, but we are pretty much maxed out in the Gulf Coast, so any growth is likely to mean export growth.
Very interesting. Patricio, I want to noodle on that same idea a little bit with you. Is growth being constrained in a similar way by rising rates and input costs and that kind of thing in the utility sector? How are you thinking about the expansion plans for some of the utilities in 2024?
Sure. So it kind of follows a similar suit, I suppose. The growth momentum is slowing in earnings for utilities, although the one, let's say, the one supportive trend is that most of the energy input costs for power production have actually declined over the past year significantly. So gas prices, as we said earlier, they've almost normalized. So that means that producing power with it is much cheaper. Carbon prices have also declined. And these are all signals that the market also expects energy demand to remain relatively subdued into 2024, because gas prices and carbon prices usually are the measures that you look at when you want to see at dispatchable power demand. So on that sense, like power generators do face let's say a worsening 2024 outlook, just because wholesale power prices are declining and are seen also almost normalizing into 2024. But on the flip side, you obviously have your more stable large utilities. So it's sort of a similar trend that the large integrated utilities will probably fare better just because they have bigger portfolios, international portfolios with a higher share of regulated earnings, which means that they are not really exposed to these decline in commodity prices and in spot power prices. So overall, let's say the message would be slower earnings momentum and also sustained capital discipline. These companies are not accelerating their spending as much as they did in 2020, 2021, 2022, just because, yeah, the cost of refinancing their massive debt piles, has quadrupled, almost quintupled in Europe. So obviously there's more capital restraint, and we also see less upside for payout growth this year. Sorry, in 2024.
Yeah, very interesting. I think this is a good point to bring on Joao. You guys put out a note looking at renewable expansion plans in some of the European utilities. So maybe despite some of the sort of general slowdown that Patricio just described, Joao, what's going on with the sort of more the green side of the equation in 2024?
Sure. So despite the capital restriction that Patricio just described, in 2024, we see our European utilities pushing ahead on the green expansion, and certainly into the midterm, as that remains the main earnings growth driver for the peer group. And just to give you a sense of the scale, we expect the average capacity increase by European utilities is planned at about 16% a year into the mid-decade. In the last 12 months, just looking at the group of the largest 10 utilities in Europe, they've added about 23 gigawatts of green capacity, and they aim to add 32 in the next 12 months. So that's about a 40% hike to their run rate. And that comes partly from a backlog of delayed projects. As Patricio mentioned, some of the issues that have faced the sector impacted particularly on the renewable side. For context, the higher interest rates, the higher inflation rates have curbed project returns, and the supply chain disruptions that we've seen, particularly in the last 2 or 3 years, have led several projects to be delayed across technologies and across geographies. And so the European utilities are still yet to meet the run rate of additions necessary to meet their midterm targets. But we do see some of the headwinds easing into 2024 and beyond that, partly from the interest rates that are expected now to ease from the end of 2024 and beyond that, as supply chain mature, local supply chains mature in line with policy plans, particularly in the US, that will be supportive as well. And then beyond that, the US and Europe remain extremely supportive from a policy point of view of the green build out. Power prices remain supportive versus the historical norm. And so the outlook for 2024, in our opinion, is a bit more supportive than 2023 and should help utilities accelerate their green growth.
Alessio, this is a great place to bring you in. Given some of the companies you look after have a global footprint, does this narrative that Joao was just talking about with growth in Europe square with other regions? How do you think about the sort of broad expansion in the global renewable space in 2024?
Yeah, so a big theme this year kind of was the difference between residential and utility scale solar. So like Joao said, there's a lot of support on the utility scale solar. And within our coverage, we look at First Solar, and they're really one of the main names that have managed to build out a really nice pipeline for expansion, and they kind of have it very formulaic. Maybe on the residential side, companies like Meyer Burger, they're having some issues in their European capacity expansion and growth. The German government last week wasn't sure whether they could continue to subsidize energy companies. So what Meyer Burger did was move its production to the US, and they're going to take advantage of tax credits from the US Inflation Reduction Act. Shifting kind of back to the utility side, we're also launching on a company called ERG. ERG is really a story about capacity expansion. So they were hit pretty hard by falling energy prices this year, but they're going to aim to double capacity from 2021 to 2026. They're aiming to double their capacity, and from that we can see an uptick of about 30% EBITDA, along with their they've got strong dividends because they're a family-owned company, and hopefully that growth will continue in the near term.
Fernando, I'd be curious to hear your thoughts on the gas side of the equation. If we keep building all of these renewables, they're obviously not dispatchable in the same way that a gas plant or a coal plant might be. And so is your sense that all of the things that need to happen to balance these renewables are occurring with, having gas infrastructure, gas peakers, gas combined cycles to be available when the other resources aren't available?
It's a different question, but for different regions. Speaking of New York and New England, for example, I think probably not. If you think we closed the Indian Point nuclear plant here and replaced it with natural gas, combined cycle gas turbines, and we are supposed to get more offshore wind and rooftop solar, obviously the development there has been much slower than anticipated. And then on the natural gas side, New York has a moratorium on building new pipelines. So we already kind of short supplied. National Grid was being sued by the state of New York because they weren't allowing new hookups where I live out in Long Island because there's not enough natural gas. To which former Governor Cuomo said, you can ship it, you can truck it. I was like, well, that doesn't work. Not at scale anyway. So they built the capacity, but is there going to be enough supply? When you move further into New England, it's even a worse situation because you can't get natural gas through New York, and then the LNG tankers, they can't come through the U.S. at all because we don't have any Jones Act compliant tankers. And that region was supposed to import power from Canada. It's no longer. It was voted down by all the 3 different states that were supposed to build transmission lines, and they've been ever so reliant on diesel. If you look at the imports of diesel in the U.S., they spike in February to March of the past 2 years, and that's even with fairly mild weather. And that's one of the reasons why we're still, despite the recent crash on it, we're still bullish that diesel will outperform gasoline in the new year. We are near 15-year lows on diesel inventories. So I guess long story short to say, we haven't done enough. Combined gas cycle is really not effective in being a backup, because you can't do the combined cycle if you're starting up in short order. It takes anywhere between 12 to 18 hours for you to get to the combined cycle portion of it. So you can't be used for intermittency. You're essentially transforming a combined cycle into a peaker at that point. And then the supply is just not there. You know, you would have to, in order to really stabilize the intermittency, you'd have to build a lot more storage, and we all know the challenges with actually building storage that's feasible for periods of 6-7 days of intermittency in the winter, for example.
Yeah, very interesting. I think that it's quite clear that there are a lot of regulatory and political influences over these sorts of markets. And given what we just heard from Fernando, and then what Alessio was mentioning with Germany, I'm curious, Patricio. What's your sense on the regulatory landscape over in Europe? Are we seeing some policymakers kind of pump the brakes a little bit, back away on any of their views on the trajectory of renewables, or is it all still full steam ahead?
So I think at least on the messaging of it, it's full steam ahead still. So it's full support from the European Commission and from the German government, also specifically on meeting those climate ambitions by 2030, which now target roughly 40% of the power should come from renewables by 2030. So on let's say on a baseline, yeah, support is still there. There have been a couple of support packages as well to try and declutter the supply chains and delays, supply chain-led delays that are hurting grid connections, and also that are impacting the deployment of offshore wind as well here in Europe, which seem promising, but it's still too early to tell if these policies will actually help facilitate deployments in the near future. And I think the other part of the story that is quite important to follow is not only the messaging, but the actual like the funding for these projects, or for this support, is that part of the equation has somewhat dialed down. Mainly in Germany, because Germany is it's actually sticking or going back to its sort of pre-crisis budget structure. So just for context, during COVID and during the energy crisis, Germany basically took an off-balance sheet fund to basically just to give some quantitative easing and sort of protect households from energy prices and all this. All of these subsidies protecting households are being rolled off in 2024. And since we were seeing a bit of also on the government level, we're seeing more capital restraint. So we're not so positive on the outlook for the regulatory landscape in 2024, especially because it is when a lot of our companies, a lot of network utilities expect to have their rates updated or increased. And sort of that's where we will see it's a balancing act. The governments will not want to increase customer bills so that you can build more grids, or is it affordability versus security and transition? I suppose that would be the way to describe it. And the jury's still out. I don't think regulators will be very motivated to increase rates by a lot.
Yeah, very interesting political dynamic there. Joao, I want to come back around to you on this topic a little bit. You've got an interesting chart from your note that you put out the other day showing the compound annual growth rate from 2022 through 2025 for wind and solar capacity for some of the European utilities, and I think you've already noted some pretty big numbers there. And I'm curious, when you were looking at that, is there much discussion on storage, particularly battery storage, or even hydrogen perhaps, but at least from the OEM side of the equation, everybody seems excited about batteries. And so I'm curious, are utilities excited about batteries? How much are they talking about it, particularly in the European context, as you've done your research?
Sure. So I think it's increasingly becoming a part of their plans, especially as most of the utilities that we cover are leaning more towards solar than before. About 60% of the planned additions of the peer group are from solar versus about 40 from wind. And what that means is that they are also becoming more reliant on battery storage. Most peers have increased their targets for storage additions over the business plans that they presented in the last year. So that's definitely becoming a more important topic. On the hydrogen side, not as much. I would say for the majority of the peer group, it still doesn't feature within their 3 to 5 year business plan. So storage definitely yes, hydrogen not as much.
Alessio, let's get the pulse from you. We've seen storage, battery storage, particular as an emergent theme for some of the, particularly the solar exposed names. What kind of attach rates are we seeing, and kind of where do you think the sort of battery equation's at the moment?
Yeah, so before some of the oversupply stuff we were seeing from like Enphase and Solar Edge, we're seeing 60+% attach rates in Europe for their battery storage, and every quarter they're rolling out into new markets. That's kind of slowed down as they kind of fix their channel inventories. But even in the US, I think batteries is going to be a major player. Like you have California, for instance, with their net energy metering policy. They're really favoring residential customers who have battery plus solar to get those that money back from the grid.
Yeah, for anyone who hasn't followed the politics in California, on the solar side, the state in this year, 2023, scaled back subsidies for rooftop solar if you just have solar, but if you do solar plus battery, it's a fairly healthy subsidy. Well, so given this is our last call of the year, I think it might be fun to just kind of do a quick round robin here on the call, and have everyone just do a quick kind of highlight of, you know, what's a key theme, and maybe you've already said it, but I'm gonna give you an opportunity to say it in different words, that you're gonna be watching for 2024. So Fernando, we'll come to you first. What's top of mind? What should investors really be focused on when they think about not just the oil market, but some of the big producing companies?
I think it's all about ultimately interest rates. It sounds very like a cop out because it's not oil related, but I think that's the biggest driver for the demand side and also for the investment side. We're getting to a point where refinancing is a concern for smaller and independent players, and that they'll have to continue to the rate of growth for U.S. shale next year will be different than this year. It takes, as much as it is a short-term decision, it's still a 3 to 6 month short-term decision as opposed to 5 to 7 years as in deep water. So interest rates will be the biggest driver of oil prices, not just this year, but probably next year.
I love it. And one of the really cool things about that answer is I think interest rates is probably broadly applicable for this group. Alessio has kind of already highlighted some of the, and Joao both, this idea that interest rates have been a demand limiting factor, particularly on some of the renewable expansions. But Patricio, let's come over to you next. What's a big theme that you're kind of keeping an eye out for in the gas and utility land for 2024?
If we can summarize it into one theme, I think it's demand. Just looking at demand levels for gas and power have declined over the past 2 years. And especially on the power side, that is a concern over the long-term prospects of utilities investments into clean energy. And that's mainly because it's expected that power prices keep on declining through the end of the decade and beyond because of the advent of these technologies. But the whole business case relies on rising electricity demand. So it seems like we've actually gone the other way, like the opposite of where we should be going in terms of electricity demand. So that's, I think, that will be the key to watch in 2024. We do expect power demand to recover, and perhaps we will see the sort of structural pieces of gas demand actually being eroded. At least that's what we believe. Gas demand will continue to be very weak in 2024, and we expect hopefully a recovery in power demand in 2024 at the same time.
Very interesting. Let's see how it unfolds. Yeah, let's come over to you. I know you work closely with Patricio, but kind of what's a big theme you're watching for 2024?
I think for our utilities, it's going to be also particularly important to see how they balance this green growth drive with maintaining healthy balance sheets and the capital restriction connected to the high interest rates that we're seeing. And so I think an important topic will be to see how they can translate this high growth from renewables into cash generation, into maintaining healthy balance sheets, and really being able to deliver on their plans, which remain very ambitious and not just from a operational point of view, but also from a leverage point of view.
Okay, Alessio, let's come over to you. What are you watching for 2024?
Yeah, a couple things from me. So maybe more of a wish list thing, but it'd be nice to see if the European Union can come up with some sort of policy framework to rival the Inflation Reduction Act. And then on the US side, depending on how the election goes, how the IRA continues to get support. And then just general macro for solar, I'd like to see if we kind of hit a floor for module prices because they've fallen quite a bit this year. And then lastly, on just the wind side, maybe a little push on the offshore side. Just this morning, Vestas announced 2 massive projects off of the UK. So maybe that could be something that carries their growth into 2030.
Okay. Yeah, for me, I will just quickly add that I think, thematically, 2024 will probably cover a lot of the same ground. I mean, I think they used to talk about all of the above, and I think that it is going to be another all of the above year. We're going to see wind and solar, or I'd be surprised if we didn't see them continue to grow at a very healthy clip. If you haven't paid attention, global installations of solar this year increased roughly more than 50%. More, and we're on. We don't have the final tally for year end, but we're going to have installed something like 400 gigawatts of solar capacity. These are just tremendous numbers, and it doesn't appear like the momentum is ready to stall. There's a lot of continued ability on the manufacturing side to produce more panels, and so if demand's there, we'll see continued growth. So I think we're going to see a lot of really big numbers continuing to come out in terms of kind of what's happening on the wind and solar side, and obviously that pairs with and feeds into kind of all of the energy complex because demand for all forms of energy keeps growing despite all the progress that's been made on the renewable front. So let's see how it unfolds. We certainly look forward to continuing our conversation with all of you who have joined us today. We will take next week off, but we will reconvene with this group and some of our other colleagues the first week of January. So I hope everyone has a wonderful holiday.